Folks, GameStop has officially woken up. Absolutely soared today, kicked some rear end, going over 110% at peaks. GameStop, of course, has been on a long-term downtrend, but today's surge might just be a game changer for the famous short squeeze stock. And in fact, I think it's not a coinky-dink, a coincidence, if you will, that all of a sudden, mysteriously, you're seeing a bunch of brokers struggle with outages. Weird how a bunch of outages just start happening right after the stock goes up so massively. In today's video, we're going to unpack what is going on with GME stock, how much further it can go, and the overall setup surrounding it. And we won't stop there. We're also going to be taking a look at Companion AMC and its current setup because it's benefiting quite a lot from the meme revival as well. I'm going to compare and contrast AMC and GME at the end of the video too, so make sure to stay tuned. Let's get right to work. Timestamps down below, and as always, make sure that you're doing your own due diligence on all ideas presented here on the channel. If you're the one taking the risk, you got to be the one doing the ultimate frisk. Okay, so in a single trading session, GME rocketed from 2-year lows to 2-year highs. So the first question is, Charlie, why did GME surge today? Well, it started due to Mr. Roaring Kitty, aka Keith Gill. Remember him? Roaring Kitty was a major early proponent of the GameStop short squeeze narrative. He even testified before the House Committee on Financial Services regarding the situation. And after about 3 years of silence, he tweeted yesterday at 5 p.m. a simple picture of someone sitting in a chair, leaning forward, holding what looks like a gaming controller. And this image set off quite the frenzy. In fact, many people rushed to buy GME in the pre-market this morning thinking, hey, if he's posting this right now, well, I saw that he posted it and the rest of the people are going to wake up to the fact that he posted it later on and then they're going to buy in after me. And all this attention is going to cause more and more people to buy in and the price is just going to keep shooting up. And if the price shoots up enough, all of a sudden the short squeeze narrative is back on. And likewise, as the stock soared, more buyers piled in, more media covered it, and the stock got more and more attention, which caused it to go up more and more, and slowly all of a sudden you're getting into the situation where we're now back at a second meme stock revolution possibility. And throughout the trading session today, Mr. Roaring Kitty posted cryptic videos of cats, Game of Thrones, and clips of relevant movies, many of which had to do with revenge, war, and an overall battle. Now you got to remember, folks, when it comes down to GME and meme stocks overall, there's a lot of emotion and loyalty. The GME setup has never been just about a stock or a short squeeze scenario. It's about a revolution. It's about this idea that here you finally have a stock that can flip the middle finger to hedge funds and the institutional traders. Ones that, quite frankly, many would argue have rigged the entire system against retail. And GME is a stock where retail finally won against the big money, and then the buy button was taken away, and there were a host of other issues that were very unfair and helped short sellers protect themselves from massive losses. So the idea that Mr. Roaring Kitty hasn't given up on GME and is back and is fighting is something that's bringing real enthusiasm back to the stock real fast. And one of the videos Roaring Kitty posted was one where Walter White from Breaking Bad says that we're not done. We're done when I say we're done. Now, on top of that, you're also getting very well-known names and influencers discussing the stock and recommending folks to buy it. Andrew Tate, who has more than 10x the following of Roaring Kitty, tweeted this out this morning. Quote, "We must unite against the Matrix, GME, GameStop, or death." Now, folks, when you're presented with GameStop or death, well, those are really just two options. And my guess is that most people are probably going to choose GameStop over death. But overall, here's the deal, folks. As GME starts waking up, it's likely more influencers and media types will start talking about it again, and Google searches for GME are already surging in a way we haven't seen in years. If this continues, oof. And in order to understand why all of this matters or why any of this matters, you have to understand that GME is a stock that rallies on retail interest. The whole thesis on short squeeze stocks is that if enough retail traders buy them, it can force the aggressive short sellers to cover and cause the retail traders to make tons of money at the expense of the short sellers that will lose tons of money. And you saw some early indications of that today. But don't get me wrong, folks. Short sellers are set up to lose billions. This could be real nasty, real fast if this trend continues. From CNBC, quote, just 1 hour into Monday's trading, with GameStop soaring as high as 110%. Short selling hedge funds have suffered a mark-to-market loss of $1.02 billion in the brick-and-mortar video game retailer, data firm S3 Partners said. And this is just the tip of the iceberg. Much more money will be lost if this continues. And short covering is just around the corner. Expect short covering in the stock as it already had a 100 out of 100 squeeze score prior to today's trading. So now I want to go ahead and dive into the short squeeze situation here. Now, short sellers tend to have the highest conviction that a stock is going to go down after it's already gone down a lot, and that is one of their biggest weaknesses. We talk about that almost every week with different stocks around the stock market. But when you open up the Gamestop situation, you see the same thing. Even though it's been decimated over the last few years, well, estimated short interest in green has climbed upward. It's climbed upward, which means that by every stretch of the imagination, now is one of the most ripe times we've seen in years for GME to squeeze shorts. Not only are we bouncing off lows, but shorts have been more greedy than ever at said lows. Ortex says short interest is at about 25% of free float, and while that might seem kind of bland compared to the 140% peak of short interest we saw back in 2021, well, you got to understand the effective short interest. The effective short interest is likely much, much higher. Not only is a significant amount of short selling done on the off exchanges, but there's a sizable amount of float that is just simply locked up and not accessible to market makers and short sellers that would otherwise be dumpitoing it every time the stock goes up. Folks, you got to understand that when you go to a broker and you buy shares from that broker, odds are more often than not that broker is going while those shares are in your account and lending those shares out to predatory hedge funds and market makers that then trade against you. But you see, folks, the thing with GME is that around 25% of GameStop shares are registered through the direct registration system, which allows shareholders to directly own their shares instead of allowing the broker to own their shares. And this is a game changer, and this is what many retail holders did to protect themselves from getting their shares lent out and traded against them. Street posted an article complaining about this back in December of 2023. They said, quote, brokerage houses can't access 1/4 of all GameStop GME shares. Here's why. And then they talked about this DRS direct registration problem. Okay, wait, Charlie, back up. Why is this such a big deal? Who cares? Well, remember, if you're a short seller, this is a disaster, a complete disaster. In most stocks in the stock market, if short sellers see a stock that is rallying that they're also heavily short on, or they want to suppress the price for some other reason, well, what they'll do is they'll go and they'll call the broker and say, lend me a ton of shares from your users' accounts. And the broker will say, yes, sir, yes, sir. They'll lend the shares over, and then that hedge fund will then go and dump tons and tons of shares onto the price, and all of a sudden that stock goes down, and they're like, woohoo, just made tons of money. We're really, really smart. Ha ha. Dumb money lost again because their analysis is just worse than ours. It's just the analysis. We're just better at analyze. But the problem with GME is they can't play this game. At least they can't play this game as well as they can play it with other stocks because brokers no longer have access to 1/4 of these shares. And that's why when a rally like today happens, it goes so crazy to the upside. Now, I want you to look at the actual numbers so that you can understand the share structure of the float and understand how ripe this trade is for a short squeeze. Now, this is from thestreet.com. Currently, GameStop boasts around 305.24 million outstanding shares and a float of 267.04 million shares. That float value represents the total issued and outstanding shares minus any restricted stock. Importantly, however, approximately 75.4 million of these shares are registered with GameStop's company's transfer agent computer share via the direct registration system, which is what we just talked about. Over the past few years, GameStop shareholders have increasingly embraced direct registration as a way to keep their shares beyond the reach of brokers and banks and consequently short sellers. The DRS method of custody provides shareholders with greater autonomy. Investors are able to register shares in their own name, blah, blah, blah. And then it goes into when shares are held by brokers, they can be lent out to short sellers seeking to bet against the company. Registering shares with a transfer agent theoretically prevents this lending. Okay, so what does this mean in effect when you're looking at the numbers here? Well, you have a float of about 267.04 million shares. 25% of those are registered with DRS and are unable to be lent out to brokers and market makers and banks and so on and so forth, which effectively removes those shares from the effective float. Insider and prominent figure Ryan Cohen owns another 12%. That means if you start doing the math, you take out our notepad here, you have 267.04 million shares in total for the float. You subtract 75.4 million in terms of the direct deposited, the direct registered shares. You subtract another 37 million for Ryan Cohen's 12% stake, and you got about 154.64 million shares left. And Ortex believes there's about 66.84 million shares sold short in total. So if you do the math on this, well, that's about 43% of the effective float sold short, 43%. And again, I believe the numbers are higher. I think that Ortex is low on this because a lot of these shares are dumped on the dark exchanges, which makes it almost impossible for people to know the real short interest. But anyways, let's just say that it's 43%. Well, you combine 43% short interest with a huge locked up float, huge retail interest, and a sudden trend break to the upside and huge momentum and skyrocketing interest. And all of a sudden you have a setup that is ripe for a short squeeze. Now, I want to talk about the broker outages for a second and what they tell us. You see, all of a sudden this morning, we had a surge of outages and issues with brokers. A lot of people say it's kind of strange that brokers that never seem to have any problems, all of a sudden, when GME is starting to wake up, have a ton of problems. Now, to be clear, GME was halted by the NASDAQ about 10 times, and that was a whole nother issue. That's just the NASDAQ's way of operating. But I'm not talking about that. I'm talking about broker-specific issues. E-Trade, for example, saw a huge spike in outages reported to Down Detector around market open morning. We saw reports of people who are trying to put an order in, and the platform said, we are unable to process your request. There's a lot of folks on Twitter reporting various issues with different brokers. You had Robinhood, which apparently had some issues executing the purchase of GME shares again this morning, and we've seen some complaints about other platforms as well. Now, why are brokers seemingly failing all of a sudden? Well, there's a couple potential reasons. Number one, again, it goes into the situation where a lot of the float is locked up. There's just not that many GME shares out there, and brokers and market makers simply don't have the shares available to execute you. I think because of all the squeezing we saw today with short sellers, you're going to see a lot of failures to deliver, as it turns out that a lot of these short sellers didn't actually have the shares available to lend out in the first place, or didn't actually have the shares to dump in the first place. Number two, and certainly a more speculative reason, it's perhaps possible that brokers have some preset level of allowed volume or increase in stock price that GME is allowed before they just start halting trading. This way they can help prevent a sudden surge from happening and forcing a recall of some of the shares that perhaps they lent out, that these brokers don't also carry the structural capability of risk managing. It's your best guess which one of these is true. You can let us know your thoughts down below. Predictions moving forward. Right now, GME is in an original shockwave as Roaring Kitty has woken the stock back up, and influencers across the board are talking about it again. But I'd expect the original catalyst pop to die off in a few days and then see a downtrend before you get the next wave. If you look back at previous cycles of GME huge euphoria, it tends to be the case that an original pop causes about 2, 3, 4 trading days of huge rallies, and then a big dump, and then the next cycle of huge rallies. And I expect this time to be no different. In fact, if today's rally sells off tomorrow or the next day, and then holds maybe half the rally or at least a third of the rally, well, all of a sudden, you're in a situation where short sellers are going to have to start thinking, maybe it's time to cover. You're in a situation where retail is going to be thinking, this stock, the momentum overall is still relevant. Let's buy for the next rally. And that can become a very, very quick self-fulfilling prophecy, and quite beautiful indeed. Okay, next I want to talk to you about AMC. So AMC originally lagged GME, but then started exploding towards the end of the day. Pretty impressive run, and this was a bit symbolic to what happened in 2021, where GME originally was the main runner, and then AMC followed suit a little later on. At the time of shooting this video, AMC had topped out at about 100% gain on the daily. Pretty nice run for a stock that has been punished so aggressively and relentlessly for years. Now, before we even get more into AMC, I just want to give you context here. I have been very vocal for years about my disgust for how AMC's board has managed AMC stock. AMC had a much, much better setup than GME in 2021, and I said so back then, but its board diluted like crazy, and it screwed it up, and it helped short sellers dramatically. Yes, absolutely, they needed to raise money, they needed to dilute, but they needed to dilute maybe a tenth of what they did. And while they were making these poor decisions, they tried to convince their retail holders that dilution was a good thing, and you had a lot of people, which looked like paid actors to me, saying that dilution is very, very positive for AMC stock. But the problem is, folks, that AMC went far above and beyond what was necessary, and that is why AMC has gone from split adjusted highs at $726 to $2.30 at lows, whereas GME in about the same time frame went from $120 to $9.95, and that's a very big difference. You got to think about it this way. AMC would have to go up around 315x its lowest share price to get back to all-time highs, whereas GME would only have to go up about 12x its lowest share price to get back to all-time highs. You got to think about it that way. AMC's holders simply became a piggy bank because of sloppy decision-making at the exec board at AMC. Yes, different companies, but the main difference here is just a different management. You look at the long-term trend of GME's shares outstanding and then AMC's shares outstanding, and it just becomes very, very apparent that AMC took huge advantage of the short squeeze situation, and quite frankly, oftentimes AMC raised capital right after AMC stock got to a new low, which was just a big slap in the face to shareholders. And they did that over and over and over again. So when people say, and they criticize me for saying that I don't really like AMC that much because of the management, well, understand that that is the reasoning behind it. And understand that when people say AMC and GME are equals, it's just simply not true. I absolutely love that AMC is coming back, and retail can certainly drive this stock higher, but in terms of a setup, I just don't believe the setup on AMC is anywhere near as good as the setup on GME. And even if it was, I would not trust it because AMC's board, again, has shown shown time and time again that anything good that happens to the stock, well, is just simply going to end in dilution. There's a possibility of making tons of money off both AMC and GME, but from a probability standpoint and from a good faith standpoint, well, quite frankly, in my view, GME's management has just simply been a much bigger advocate for the retail trader as compared to AMC. And I personally think that matters. I personally think the characters that are in charge of a company, well, that matters. And because of that, I have to say that GME is the better stock of the two, and it's not a close match. It's by leaps and bounds. So anyways, that is my standpoint. Let us know your thoughts down below, and I appreciate you for watching the entire video and hearing me out. We'll see you in the next one.